Go for it. Okay, we're going to give it just a few more moments and then we will start. Okay, I think we're going to go ahead and get started. I want to be considerate of everyone's time this afternoon. Welcome to Creating a Bankable Loan Proposal Part 2. My name is Paula McCain. I am a recovery business advisor for the North Central Texas Small Business Development Center. Today is National Cream-Filled Donut Day, as well as National Eat a Hoagie Day. If you haven't had lunch, there's a couple of suggestions. The SBDC is a leading provider of assistance for small businesses. We are grant funded, and because of that, we're able to bring webinars such as this to you at no cost. Again, welcome to Creating a Bankable Loan Proposal Part 2. Please put your questions in the chat room, and at the end of the presentation, we'll have those conversations. I want to introduce Rebecca Schultz, one of our favorites. Rebecca's been helping business owners access money and financial education for over 25 years. She is the founder and executive loan consultant of Centerlock Funding. Rebecca, thank you so much for joining us again today.
Thank you guys. We have so much fun together. We really do. Now we're continuing the conversation. And I love this conversation. I'm in it every day. Give me just 1 second. I'm going to make sure you guys can see what I can see. All right. So we're talking about business loan proposals. This is part 2. All right. My name is Rebecca Schultz with Centerlock. I do this every day for a living, right? Help people find money. And I am sharing my secrets with you, right? My goal is for you guys to be strong and viable and to be able to easily navigate the conversation of money. That being said, you know I love little memes or I love little quotes. I found this quote and I thought it was really important for today's conversation. So we're going to kick it off with this. This is the 2 words, information and communication, are often used interchangeably, but they are significantly different things. Information is given out, but communication is getting through. All right, so whoever Sydney Harris is, right? Great conversation because we are talking about not only information and creating these loan packages, right? But be creating a strong communication. And we want to make sure that we're good on both sides, that the information we're providing allows for strong communication going through. All right, so with that, we are going to separate the conversation into these beautiful 6 points. 6 points today, right? We're going to expand on that required document conversation that we went over last week. I want to revisit it and I'm going to throw you guys a example or sample, and we're going to think through what that business owner is going to need. I want to make sure that you understand how the information from the package goes in and supports the conversation that the applicant, which would be you, is trying to have. Then we're going to go beyond that phase, right? We're going to push through. And what's that actual loan process looks like, right? What happens next? Once the package is created, what starts to happen? So we'll walk through that conversation. And then I'm going to share my 3-point check. All right, I know this sounds so easy because it is. It's the 3-point check. There's only 3 things you need to think about in it. And so I want you guys to go over 3 key areas to make sure that you have a compelling statement to the investor or the lender. Right? I want to just dabble into ratios. Okay, I know ratios makes people think of math and they all panic. So do not panic. Right? Ratios are your friends. They're just relationships between data points. So we're going to go over some key ratios that you need to know, and then I'm going to connect that to the 3-point check so that everybody knows how to measure where they want to be. Right? And then I'm going to tackle one of the biggest challenges that business owners are facing when they get to this capital conversation, and that's lack of collateral. Right? So what happens if you're a service business and you don't have tons of collateral? Is that going to be a problem for your package? So right out of the gate, I'm going to address that problem. We're going to talk about it in more detail. I'm sure there's going to be lots of questions about that, but we'll address that. And then we're just going to basically hit a summary, which will be a pause in the conversation because we have one more part, right? We got part 3. So we'll at least summarize what we've expanded on today in part 2. So we are ready for part 3 for the grand finale. Does that sound like a good mix? All right, so let's get going. All right, so let's expand on that document requirements, because where we left off the conversation last week is that there was like 3 pages of documents that you needed to get to put a strong loan proposal together, right? And it was just exhausting. And then I put there, you may not need it. And then I try to connect that to, well, it's about the story that you're trying to tell. And I don't want to lose people, right? So because the loan proposal is largely the documents, the information from our quote, we want to make sure that the information actually allows for communication, but we got to make sure it's getting through. All right. So just revisiting this and then giving a summary about it. Right, so remember, we got to tell the historical financial story, and it starts with the person, all majority owners of the business, 20% or greater ownership, want to see their 3 years personal tax returns. The look back or the rear view mirror is always 3 years. Right, so 3 years personal tax returns and 3 years business tax returns if the business has a full 3 years that has been operating and has filed taxes, right? If it hasn't, remember, you're going to give them what you can, right? So if it's only been in business for 1 year and all you have is 2020 tax returns, that's what you give them, right? And just know that you've done your best. Right? And then we've got to see where we are right now, right? Where are we right now? That's the interim financial statements. We want to make sure that we have the interim, that's this current year up to current time, so typically January 1st of the beginning of the year to that current period or close of the last month. We want that profit and loss statement, also known as income statement, and balance sheet. All right, and then we got to think about what's going to happen in the future, right? So that's going forward. Right? And with that, we want a projection. We want 3 years going forward with the first of those years broken down in a month-to-month standpoint. And remember, that's pretty important because we're asking for money typically. And so we want to show them how we're going to use that money and how that money is going to support the business. Right? You've got this whole ask happening. I need X amount of dollars to do Y things. We want to be able to show them how once that money goes into the business, how that's going to be accomplished. What does that look like? Right, so that's the financial information there, right? That's how they understand what's happening. And then we're going to include the personal financial statement. So how strong are those borrowers? We want to understand the team, right? Because again, it's all about leadership. You need to have the right team in order to win. We talk about the skin in the game or that capital injection. You can't borrow all of what you need. Typically, you've got to put something in order to offset the risk to the lender. So that's your capital injection. You want to make sure you're accurately understanding your working capital needs or your expenses. So how much money do you have to last until you become, self-sufficient? That's called runway or working capital. If there's any issues on credit reports, that's for the person, those majority owners, or the business. We need credit explanations. We'll talk more about that in a minute. And then you want to kind of tie it together with what we would call a summary. You want to tell about your business. What does your business do? How long has it been doing it? What your ask is. How much money do you need? What are you going to do with that money? That's the sources and uses of fund. Then you want the collateral, right? How are you going to pay back the loan if you're not able to generate the cash flow? Right? And then there's that personal guarantee, especially for small businesses that don't have a lot of business credit. There's got to be somebody to step up and offset the risks to the investor with that personal guarantee if the business can't do it. I know, and it doesn't end there, right? I told you it was a lot. Then we have this whole collateral detail. Because collateral typically is an important part of the conversation, we need to make sure we're giving them the detail they need to know what they're taking as collateral. And if we're using this money to purchase things, inventory, equipment, whatever details about the items we're purchasing needs to be captured. And then all things that have risk oftentimes have insurance, right? It kind of goes hand in hand. And so they need to see that you have insurance to protect the company, right? And then, of course, information about your industry. This we equate to the environment, right? So how's your industry doing? Is it struggling right now, or is it tied into some other kind of commodity? You need to be able to have an idea of what's going to be happening in the industry or what's happening in the industry. And then, of course, a credit report, which I'm a big fan of having you pull your own credit reports if at all possible. And that way you know what's being said about you before it becomes a surprise. Right. Now, just note the little asterisks next to these items. Those are things that you build or weave into the story. All right. And you can support with additional outside documentation. Okay. Now, I'm going to bridge this knowledge with an example, right? Because what a lot of people get is they get into the weeds and they're making notes about 3 years tax returns, interim financials, and they're not seeing the big picture of how this connects to an actual request. So we're going to do that here. We have example A for you. All right, I'm going to tell you about this business owner. His name is Marvin. Marvin owns an automotive repair shop. Right, he fixes cars. Right, he's been in business his whole life. Right, so he's been in this business forever. His father had a shop. His grandfather had a shop. Marvin's been in this a lot. All right, now he started the shop that he's talking about a year ago, and everything's going really well for him. Old customers that went to Marvin before, they're coming to his new shop, right? They're coming in daily, and he's getting a lot of referrals, right? That's fantastic. But remember, the upside of doing well is that it typically requires more capital, requires that he hires more people, and that's exactly what's happening. Marvin needs to hire more people to keep up with this demand. And if he hires more people, he needs more equipment. So there's the need. All right. He estimates to get everything he needs, the equipment, and to cover 60 days worth of payroll, he's looking for about $52,650. Note, that is a very exact number, correct? All right, he's not saying, I think I need. He's not saying, I should only need. He's got a specific amount, which means that most likely Marvin's done a little research. He's thought about this. So coming back to this scenario, what kind of documentation do you think Marvin's going to need out of this original list? Let's start back with this page 1. Right? Can Marvin come up with 3 years personal tax returns? What do you think? Yes? Okay, so most likely Marvin's been around, right, and filed tax returns for 3 years personally. So he himself, as the majority owner of the business, should be able to provide the tax returns. And that's going to show that he's made money in that industry, even if it isn't with the business, right? So that's part of that character piece. So the big thumbs up. Okay. Can Marvin come up with the next item, which is going to be 3 years business tax returns? Notice it says if applicable. The answer is no, right? Marvin's only been around for a year, so he can't do the full 3 years, but he can do maybe the last year. He just wants to be really specific on when he opened, right? And then what that year of tax returns actually marks. It may not be a full year of business, right? So if he started in February, right, and he ended his tax return in December, that's only 10 months. That's something that's important to point out to the investor. All right. Can Marvin provide an interim profit and loss and balance sheet? The answer is yes, right? He should be able to. So Marvin's story is he's growing. Demand is crazy. He needs to hire. We would anticipate in his financial story that those interim profit and loss or income statements and balance sheet actually shows that his sales have increased from the prior year. I should have evidence connecting that. That's going to be important to the investor understanding the conversation. All right, next, 3 years projected cash flow with the first year broken down to month. Can Marvin do that? Big yes. Yes, Marvin can do this, right? Because it's important to show the investor that the money that's coming in to the business is going to be used to purchase the equipment, to pay for the payroll. Now, that's a little scary to an investor, right? They might see that Marvin's doing well, but they want to know that the money that they're giving is going to actually improve his business. Remember, we don't want holes, right? That's money going into a deep hole that doesn't see the light of day. Investors want to see where they put money in and more money grows, right? More money is able to come out of it. So that projection is going to be critical, especially since Marvin doesn't have a full 3 years of back history on the business. That's going to be pretty critical to the conversation. They're going to want to see that money coming in, that $52,650 coming in, how he's going to spend it, right? How much increase he's going to see once he starts hiring new people, the conversation around how he's going to see growth around having those new hands. That's going to be an important aspect that they're going to want to measure. So that those details, right, are going to be in that next item, those written assumptions for cash flow projections. And the way those details come in is hopefully Marvin's thought about, how many people he needs and what positions and how he's going to be able to take those labor hours, for instance, and build more revenue around them. He should be able to make that bite-sized chunks that help explain or really connect the information or the need to the story, right? So written assumptions. All right, personal financial statement. Can Marvin come up with that? All right, the answer is yes, right? They want to know about Marvin, right? How solid is Marvin as a business owner or as a guarantor? Small businesses that are young like this, they don't have a lot of history under the business. And so that personal financial statement is going to be used in order to know whether or not Marvin's been successful in the past and if he has, a measure of financial support that he brings to the picture, right? Um, doesn't happen often, but every now and then I get business owners that have more credit card debt and more house debt than they have money in the bank, right? Or assets. They may not own a house. And so when they look at a personal financial statement, they're looking at their liabilities versus what they've been able to grow in assets. They're at a flat, negative or zero. It doesn't lend a lot of strength to the deal, right? And I want people to understand that that's not the end all be all, but it says a lot about a person's financial well-being and the ability to last through crisis if they have something to fall back on. right? So personal financial statement is your fallback. It's your personal experience in navigating the waters of finance and trying to build an asset similar to what you're doing for the business. You're building assets. All right, next, teams, right? Resume for the team. So they want to know more about Marvin, right? The fact that he has grown up in this business and has mentors like his father and his grandfather that can jump in and support him, coach him on owning this type of business. That lends high value to the fact he can do this, right? Maybe he wants resumes for the operations or the back office team. Whatever he needs to show that he can successfully scale and lead a group of individuals, right? That's what he needs to build into it. Right, so far so good, right? Like we're figuring this out. All right, capital injection. So you think Marvin needs some injection money on this deal? Would you say yes? Yes, right? He's purchasing assets, so he's going to need some injection. This is an investment. The lender's not going to want to give him 100% of the investment. What if it fails, right? They don't want to be 100% out of pocket. They're going to require Marvin to step in with some money. And remember, it fits the story. Marvin's doing really well. He wants to grow. That means he should have money in the account that he can also contribute to this, right? The story isn't that he's destitute. So we want to make sure that it's matching the story. All right, working capital needs or runway. That is a big conversation for Marvin. Do you think he has what he can state to show he's got runway? How does he do that? Well, the answer is he should, right? Runway, right? Having working capital is going to be measured by a balance sheet showing how much cash he's got in the account. And it's going to be measured by his projected cash flow, that 3 years projected, that first year broken down month to month. That is how they start to understand if he's going to be profitable and what his expenses are that he needs to make sure he's covering. It's your expenses, right, on that projected income statement, as well as what you've got in the bank account as cash or near cash assets that helps you understand runway. All right, credit explanations. Does he have what he needs for credit explanations? Maybe, right? We don't know. We don't know Marvin's credit. I would assume it would be pretty okay. I'm not reading anything of distress, but he needs to pull his own credit report and he needs to look at that in detail and make sure that if there's anything derogatory, that he's writing a letter of credit explanation detailing what happened and therefore helping people understand it ahead of being judged on it. That's how that works. All right, and then executive summary. Do you think that Marvin can come up with a understanding of his business, what he's doing, and what they've been able to accomplish so far? Pretty simple, right? Doesn't need to be fancy. It could be a couple paragraphs, but he just needs to tell what he does, what services he's offering, why he needs the money, how that money's going to help him, right? Something into words. And remember, the ask, how much he needs and how he's going to use it, is going to be a big part of his loan package, right? They want to understand that, right? Collateral. Does Marvin have collateral? The answer is yes. All right, Marvin has collateral. All right, so he's got equipment, all right, he's got tools, he's got a shop already. Now, it doesn't look like, or we don't know for sure, but it doesn't look like he's leveraged any of that. It seems like he's purchased it himself. He's also purchasing more equipment, right? He needs more tools for these people that are going to be working with him. And so that asset itself, that purchase, becomes collateral. So the collateral that we need to document in this conversation is going to be all the equipment, all the tools, everything in that shop that is an asset that can be used to generate more cash. That is going to be the collateral. Now, granted, do you think that he's got at least $52,650, the amount of the loan, in collateral? I don't know, right? We don't know. We would be looking at their balance sheet to understand what the assets were, because that's going to be what we call a fixed asset, right? The balance sheet would tell us whether or not he has that. But since he's using the money for equipment, he already has equipment, I'm going to wager that we're probably in a pretty decent conversation on collateral, right? We would just want to document it. All right, so should Marvin consider doing a personal guarantee or being included in this conversation since it's a young business? Do you think that's something that he has to worry about? The answer is yes, right? It's a 1-year-old business. There's not a lot of history on that puppy. So I'm going to wager that he's got to be ready for a personal guarantee. So he should be signing documents and making sure that that is known that he's willing to guarantee this money. So it also means that if it doesn't work out, Marvin's stepping into the reins and he's going to pay it himself, right? He and his family are going to pay this if the business doesn't succeed. All right, we're almost on the end here. Okay, who determines the value of the collateral? All right, so I saw you, Roger. That's a great question. In most cases, for the initial loan review, they're going to use the balance sheet to determine the value of the collateral. We call that a book value. All right. Now, note that many lenders may want to do either a desktop appraisal on that equipment, right, or send an equipment appraiser out there for something that's really small, like 52,000. I doubt they're going to spend $1,000 to document the collateral value, but those are options that are out there. In most cases, they're going to be looking at that balance sheet, which, if you understand how that's booked on it, that would essentially be the money he spent for the equipment, less any allowable depreciation for use, right? And so it would be the original price of purchase minus depreciation or used value of those assets. And so the difference, the actual fixed asset that would be adjusted for depreciation, is the value they typically look at. All right, so then we're purchasing equipment, right? So we need to go ahead and make sure that we've got the purchase orders for what they're trying to buy. That's going to be an important factor. They want to see how much the purchase price, because guess what? They're going to include that purchase price as the value of those assets. It's almost like a net value for that type of equipment. And then you've got the collateral from the past, right? So we're looking at that book value plus the new equipment purchase value. Right now we have an understanding what our asset value is in most cases. Right, insurance. So I guarantee you Marvin isn't out there like a loose cannon, just doing business without insurance. I guarantee you he's got some insurance. So we want to make sure that he's got enough insurance to make sure that the lender and the investor is covered, right? So if something happens, a hurricane blows through, there's a theft, there's a fire, who knows, right? That the lender, the investor, and Marvin himself are protected against loss. All right, and then so notice we had our asterisk details here, right? Industry detail. So how's it going in the automotive industry? Is growth predicted for the automotive industry? Right? Are people like Marvin who have these type of shops going to do well? That's one of those things that you're going to go out to maybe IBIS World or some other type of economic forecast and really get behind the industry and know it, right? Lenders or investors are going to be looking for information, but you have this rare opportunity to provide quality information from your sources that should hopefully be a compelling case towards your need, right? For in this case, it would be great if Marvin was able to connect industry growth like they anticipate automotive industry repairs increasing over the next couple of years, right? That would be a fantastic story to show, claiming that his desire to grow is actually within what they're anticipating for the industry, right? That would be consistent conversation. And of course, he would want to include, in my case, I would recommend include a copy of the credit report. You can get a copy for free. It doesn't cost you anything. It saves lenders from having to pull a credit report initially just to see whether or not they want to talk with you. They will eventually, whoever you go through, will pull their own version of that credit report, but this at least reduces or minimizes the credit pulls and gains more confidence going into that investor's office. All right, so does that make sense how you use that type of checklist, and then you look at your situation, right, or an example, and you start to understand what documents do you need to consider to connect to the story to give the investors everything that they need in order to start supporting you, right? Answering their questions with the information that's going to bridge that communication, just in our quote, right? All right. We're all up to speed. We're all up to speed. We know how this works now. All right, so what's next? What's going on in this loan process? What do we have to anticipate? I love this. All right, so I divided this conversation into the players, right? Or if I could say it better, the players. All right, so this is who you're going to be working with. All right, one, you're going to be working with relationship managers. All right, that is a role that is played out there in this type of investor world. All right, and then you're going to be working with loan processors, completely different role. And then hopefully you get over to these underwriters. Again, another role, right? And then I'm going to throw in there this whole SBA role. What is going on with this SBA person, right? Or this department? All right, so these are the players. Now let's see how they all work together. Okay, so your relationship manager, they are usually the person that greets you or picks up the phone. They're what we call forward facing, meaning that they're there supporting you with your questions, concerns, process, right? They're the communication piece. I like to think of them as the eyes, the ears, and the mouth of the operation. All right, that is the person that you typically will deal with or be forced to deal with, whether you like it or not. All right. Now, when investors hire for people in this role, they are all very, very similar. It's almost like a stereotype that keeps getting played out over and over again. Okay. So I am playing with the stereotype here. I am playing with it. They're outgoing personalities, very friendly, right? But they're not often good with details. All right, they're good from going one conversation to the next, but remember, they're talking to a lot of people every day, right? And they are always running in between meetings. And so the details, that's where it becomes problematic. And I want you guys to realize that that's unfortunately the kind of hazard that goes along with their job. You have to keep up with the details for them and be their taskmaster. You have to set out what you need from them, and when it needs to be delivered, you need to help them a little bit. Now, I put in here like hiring criteria. I know that seems like I'm hiring somebody, but I just want to explain the level of education and experience in each of these player areas, right? Because I think when you understand who you're working with and who you need to get to next, it gives you a little bit of compassion for the type of person, their situation, and more importantly, how they can help you. All right. Now, unfortunately, our forward-facing relationship manager folks, they're going to be the least educated people that you're going to run into in this conversation. That sounds horrible, right? And I'm not saying they're poorly educated. There's just not a lot of requirements for their role. Okay, so they will typically have a college degree or they'll have 1 to 2 years of experience. All right, and they're usually very positive in appearance. And they're good to meet with, and they are really good at coming up with sales goals. All right, these are salespeople. They're good at sales. All right, not with understanding the detail, not with mentoring and guiding. They don't have the capacity to do that level of support. All right, and that's not their fault, right? They're typically young. All right. Now let's move ahead, right? Let's talk about the next player. That is going to be this loan processor. All right, these are behind the scenes individuals, and their whole entire existence in their organization is to gather information and to review the details. All right, they're going to catch those details and they're going to start trying to connect the dots, similar to what we were talking about with Marvin, on what he was asking for and what we needed to provide. That is a loan processor. All right, they're going to want to make sure they got everything that they possibly can to show as more complete of a conversation as possible, and they're going to be tuned into the accuracy. If they see that you forgot to dot an I, this is going to be the person that's going to catch it and respond back to you. All right. They do not go into the information and analyze it though. All right. So they are just dealing with information, incompleteness, and checklists. All right. They're not the one that will talk to you about your business. They are very reserved. They don't want to say the wrong thing. You won't get a lot of information from these individuals. All right. Now, what is their hiring criteria? Right. So they typically do have a college degree and at least 2 or more years in banking specific or in investment specific. Right. They will have credit analysis certification. So although they won't be talking about your business, they are certainly analyzing your business. Right. That's part of them making sure that they're getting everything they need to show a complete record. Right. They have strong bank training. All right. These individuals are constantly being retrained, and it's always around risk. They're trying to understand your risk and they're trying to gather the information in order to offset the risk or to show the best possible picture to the next person in line. All right, just remember these individuals, whereas the other ones were friendly and open and good to talk to, these are rule followers. All right, they're checking for those items and they report back to management. They do not report back to you. All right, and that becomes painfully obvious in any conversation. It doesn't matter which organization, it's just how it goes. Okay, so now you see those first few people. All right, let's talk about the next player. This is the most critical player, honestly, in this situation, and that's going to be the underwriter. Now, the underwriter is like the man behind the curtain. All right, and it could be a woman, it could be the man or woman behind the curtain. They're behind the scenes, and you will almost never have the ability to talk to these individuals. The way the investing world works is they keep underwriters uncompromised. Their judgment and decision-making skills needs to not be swayed by anything. All right, and so that's why you'll never often get the opportunity to talk to this person. All right, they are, as the relationship manager was the eyes, the ears, and the mouth. This underwriter is the mind and often the final decision maker. All right, I know that's scary. All right, they are often an introvert. I'm not saying they're all this way, but they're often an introvert, meaning they're very reserved. They tend to be very self-involved there. Okay, and they are extremely detailed, and they have excellent memory. Like verbatim, this is how they hire. This is how they decide who gets these roles. Right? These are the characteristics that make them very good. Extremely detailed. Excellent memory. They are sniffing around like a bloodhound, trying to figure out where the bodies are lying. Okay. Now, these individuals prefer documentation and communication, and they do not want to mix anything up. They are slow, very, very, very detailed, and if you can come up with a strong package that gives them that level of documentation in detail and give them clear communication that again addresses directly to areas of concern, you'll do well winning them over or at least coming off is a strong risk to them. Okay. They do not make decisions quickly. All right. They will take forever to make a decision. And that's just the honest truth. Now, this is what I see, they don't always see, is that although they try to stay as unbiased as possible, and that's part of the reason why you don't ever get to talk to them, right? Because they don't want to be swayed, they still are subject to bias. Right? And that's just humanity, right? They're subject to bias. And so oftentimes you have to understand that that's part of the game that they play. That's their role. And then you have to be able to help overcome some of these biases. And so we'll talk about that next week, biases. All right. Hiring criteria. This is what I wanted to get at. right? You want to, you know who's working with you and what kind of person you're dealing with. The people in the underwriting role, they will have at least one college degree, most often more than one, right? They're preferred to have an MBA or a master's in business. These people will typically have 10 plus years of high level bank lending. They're going to be highly trained on risk, and that goes into monthly, weekly economic forecast training and updates. Right, so these people are always in the world of loss, risk. That does something to your mind, all right? It does something to your mind, but that's the world they live in. There's a lot of pressure that they do not lose money, right? And if they lose money, if they make a bad decision, that impacts their job security. So they're very, very concerned about that. All right. Oftentimes, the underwriter, because of their senior level, they're given management authority. So the processor will often report to the underwriter, not always, but often, right? And the relationship manager will be reporting to this individual, right? And so it's not that they always report to it, but you have to understand there's an internal pecking order, right? And so this person's always going to be on top. So if you think about it, your relationship manager, who's wonderful to work with, once they get to somebody in the underwriting world and the underwriter doesn't like the deal, do you feel like they'd be able to sway the underwriter? Highly unlikely. All right. That's the way the cards are set up. All right. So we're talking lots of generals here. We're not done, right? There's still one player in this conversation, and that's the Small Business Administration, or SBA. Now, ironically, SBA is not directly with the lender. They are a partner to the lender, or they're a separate entity. The Small Business Administration guarantees loans to community lenders, right, or lending partners, right, and they support them. All right, again, separate entity, they support them. Now, if the loan is approved through the lender, but they want a little bit more security, they want a little bit more assurance that they won't suffer a loss, SBA can step in with their guarantee and offset that loss. And they offset it to a percentage of the outstanding or remaining balance. Now, there's two ways that SBA can approve that loan. There's one where the community lender has the authority internally, they're experienced, they have the authority internally to make that decision for SBA. We call that a preferred lender relationship. And there's a second where we call it a guided approval relationship, where they send it off to SBA. It takes 7 to 10 days typically, and SBA underwriters review the deal and make a final decision. Just understand that if SBA makes the final decision, that is less risk for the lender, right? The lender doesn't get their hands slapped if you fail and they didn't catch it, right? That can happen to a lender who's using preferred lender status to make decisions. So there's two different ways that lender can submit your deal, which will impact whether you get the loan and then the time frame to which you do see funding. I always like to make sure people understand that. All right, so there are fees associated to SBA loans, and not all community lenders like that, right? There's ongoing fees. You just see the initial closing fee. Ongoing fees that the lenders are paying behind the scenes are a guarantee fee for every loan, every SBA loan that they are protecting in their portfolio. If they miss a guarantee fee, and those are due monthly, then they get their hands slapped and they could lose the overall guarantee, which makes them virtually unsecured loans or very risky loans. So there's a lot of stress behind having an SBA loan program going, and there's strong requirements that those lenders have to adhere to in order for them to keep the portfolio solid and strong where they can continue lending. Right. The reason why I like to state this is because there's a lot of players that you're going to be working with, and there's going to be a lot of information, right, and a lot of communication happening. If you're not careful and you don't understand who you're communicating to, right, a lot of people prepare that initial package or loan proposal for the relationship manager. That's not who it's being prepared for, right? It's being prepared for down the road the loan processor, the underwriter, and ultimately, potentially for SBA itself as an underwriter. You have to communicate to all of those players sufficiently within your proposal. Does that make sense? All right. Any questions?
Uh, just a real quick comment, Rebecca. That was by far the best analogy I've ever seen for the players involved. I feel like I just went through a disc assessment. You nailed like each one of the people involved in that. So that was great to see. Um, now I say we because the SBDC kind of plays that glue role amongst all of that as we work with the customer. So just that was my only input is that's kind of how we help interact with some of those players as well. So
Oh, I love that. That's a great point, Roger, because oftentimes for the business owner, you're trying to run a business, right? It's very hard to worry about, am I saying this right to the right person? Is this going to come across to that third person down the road in the right manner, right? You need a coach. You need somebody who can run the ball and make sure that all the communication's going smoothly so you don't drop something and then it is perceived in the wrong light by somebody else. And so that is true that those SBDC advisors are essentially like that coach, helping that communication, smoothing that out, and making sure that you're picking up on the details that you need in order to be efficient and effective and compelling in that conversation. So good point. Thank you. All right, so I'm going to share with you my 3-point check. I don't share this with many people, all right, but it is super easy. And if you do the 3-point check on your business, I promise you it will help you come out with a solid plan, okay, a solid proposal. And it's just like 1, 2, 3. It's that easy. All right, so the purpose of this is for you to do a quick review of critical areas. These are the top 3 of the 5 C's of credit that investors are looking for. They want to understand your cash flow, they want to understand your collateral, and they want to understand your credit. Cash flow, collateral, credit, 3 of the 5 C's. All right, now let's break it down. Cash flow. Right, the question they're trying to answer in their mind is, can you afford to repay back the loan? Right? They don't want to give you the money and have you not be able to pay them back, right? That's a hole. We don't want to be in a hole. Okay? We want to grow a money tree. All right, so they're going to look at the historical cash flow and the future cash flow to determine whether or not you're going to show sufficient money in the future or now to repay back their loans. In a minute, I'll show you exactly how to calculate this yourself. Right? Now, traditional lenders like your banks, your credit unions, they are cash flow lenders. That's what we call them. That's because this is number 1 on their mind. If you cannot cash flow or repay back the loan in your initial proposal, don't even go to them, right? Pack it up, call it another day, and walk away from them. Okay? And again, this is related to those capacity factor for the 5 C's of credit. Capacity for the 5 C's of credit. All right, here's the collateral. That's point number 2. It answers the question, how do I pay a lender back if a deal fails? Right? Because remember that lender, they don't like failure, right? They can't lose grandma's money in that bank. That's going to shut them down, right? So they've got to make sure that this is a winning deal. They're going to get paid back. So they're going to be looking for secondary sources of repayment, right? And that could be either outside sources of income outside of the business. That could be collateral that's liquidated or easy to liquidate and repay back the loan. That should be strong guarantor certainty for repayment. So for instance, let's go back to Marvin, right? Marvin's been fixing cars his whole life, basically. And if Marvin's shop failed, most likely Marvin could find another job, right? Like he's been doing it his whole life. He could probably even go work for his parents if he wanted to. And so would Marvin have the ability to pick up another job and start generating money? That's what I mean by guarantor repayment. Is there certainty that they'd be able to go into a trade and quickly start to pay back their personal debts? And so these are formal understandings of how they reverse risk, right? From a documentation standpoint, remember the information side, secondaries as sources of income, maybe a spousal job that's bringing in steady income to support the household. That would be one way to document it. Maybe the collateral values or details would be a way to document it. Or those 3 years personal tax returns showing that Marvin's made money outside of the business and will continue. You see, think about it that way. Those little details come into these conversations. All right, so traditional lenders, they need to document all 3 sources of repayment, not one, right? And so they won't document something that they can't see. So you need to make sure that they have that level of support detail in the package to document it. And your collateral, well, it's related to your 5 C's of credit as form of collateral, right? Pretty simple. All right, the third point is going to be credit. Now, notice that I put credit at the very end of my 3-point check and not at the very beginning. That's because, believe it or not, credit is not as important to me as a lender as cash flow. All right. Credit is kind of like an after effect, right? This is answers the question, can you prove you've paid other people back? If I can show that you can pay the loan back and I can show you have collateral to pay me back if the cash flow doesn't pan out, well, then it's almost a given that you're going to have fairly decent credit, right? No need to pull credit in that case, right? If I can't get you past the first 2 humps, most likely the third is not going to be good. But if I can get you through those first 2 questions, right, then it becomes something that I need to check. So histories of repayment is important to creditors. All right. Ironically, it is all a stair step. I'm telling you, it's almost comical. If you have successfully borrowed money for your business from another institution, you will easily find that same amount of money available through a secondary institution or competitor institution. If you need to borrow more money than what you've historically borrowed for your business, say twice as much money. You got 50,000 last time. Now you need 100,000. Then it becomes harder to get the loan, right? If you're asking for another 50,000, they'll almost give it to you blindly because you've had history paying it back. It is comical. All right. So just understand that personal and business credit scores are pooled. So I would recommend you pull those on your own. Okay, Experian Business Credit Report. They actually allow for a blended credit score review, so you can get the business and the personal, just from me to you. All right. If there are credit challenges, meaning that you've had issues in the past, you want to make sure that you're documenting those, right? That's that credit explanation letter that we mentioned earlier. Right. Remember, business credit is more important than personal credit. So if you've established business credit, big thumbs up. But if you're like Marvin and this is your first time applying for it, go slow. Don't go quick. Go slow and make sure that you're making a good decision for your business. There's too many predatory lenders out there trying to take advantage of you. Okay. So credit, believe it or not, fits into our 5 C's. It is part of the character aspect. All right, that's that character conversation. So much is a part of character, like your resume, your experience, right? But credit shows whether or not you've historically paid people back, and that's part of your big 3. Okay, so go ahead. I don't know. Okay, so I want you guys to do the 3-point check on yourself, right? Do the 3-point check on your business loan proposal to see how you did. Think about these 3 areas. Like, can you improve the conversation? For instance, let's say your collateral is not so strong, right? Can you improve it? By the way, we're going to talk about that in a minute. I gave a whole section dedicated to collateral, so we'll talk about ideas. but you need to figure out if there's ways you can document it and make sure that you can get some certainty within the proposal. All right, and then remember the other two areas of the 5 C's. All right, so we went through 3. The other 2 is capital. That's your capital injection, right? You need to make sure you can document that. And then conditions. Is it the right time for your business to grow, for the idea that you're trying to do, right? You'll need to somewhat document those conditions. That's also your industry as well. Competition is part of conditions. All right, so think about these 3 as you're going into your proposal before you hit up those investors, right? Make sure that you're covering things in the right way and you've got a green light to move forward. Okay, so as you're thinking about your 3 points, right, I would be just losing you if I didn't tell you how to actually do the measurements. Right? And these are the ratios, right? Ratios. I love ratios, relationships between numbers or data points so that you know more about your business. So I'm going to just point out 3 ratios that I want you to think about. Right, the first is about measuring capacity. Remember, capacity was that first item on my 3-point checklist, right? And so that is the debt service coverage ratio. And I don't want to lose you here, right? Know that you'll get a copy of the presentation, so you don't need to be stressed about missing something. But to measure your debt service coverage ratio, it's very simple. You're taking your net income from your profit and loss statement, also known as the income statement. You're going to add back in depreciation if you've taken that out. If you haven't taken out depreciation yet, no problem. You're just at net income. And then if you have taken out interest expense, that is interest payments that you are paying back other investors for your business or other loans for your business, you add back interest expense and you add back any non-reoccurring expenses, right? Like let's say a hurricane came through and it flooded your building and that cost you $100,000 out of pocket to repair. That particular year, when you're talking to investors, that's an anomaly. That's not something that's going to happen over and over again. You want to add back in the $100,000 repairs because it's not something that's normal for your business. That's what I mean as an example of non-reoccurring expenses. Okay, so that gives you a measure of your cash flow. You're going to look at that cash flow. Remember, this is whatever period or time frame you're looking at that cash flow. So let's say that's for a year. Right, you're looking at January 1st of 2020 all the way through December 31st of 2020. That would be 12 months. So you'd be looking at that 12 months worth of cash flow and you compare it to 12 months worth of repayment. Right, so that's going to be principal and interest payment for the new loan that you're proposing and any existing debt that you have to repair. So I'd be looking at cash flow and debt payment, right? Those are the relationship factors. So the goal would be to have at least $1 of cash flow coming in from the business operations to repay back at least $1 of debt repayment, right? And so then at least was breaking even. Well, in this business world, you don't just break even, all right? You want to at least grow. So for every dollar of debt that you're having to service or pay, you want to make sure that you have $1.25 to repay it. All right, so you're always keeping that extra quarter in your pocket. All right, and so this measures your ability for your first point of your 3-point check for you to pay back or have the capacity to pay back the investment. All right, next, we've got measuring debt leverage. Okay, so that's a banking term, and I'm teaching you banking lingo. This is really like how much debt do you already have in comparison to your assets. If I had to do a fire sale on your business, like everything's got to go, right? Would you come out okay, or would you owe your creditors more? Eek, right? Okay, so there are metrics for this. We can call that the current ratio or even a quick ratio. Some businesses have maybe inventory that doesn't move very quickly, right? Inventory is a current asset. And so maybe that's not as indicative of a quick fire sale for you, right? So then you'd want to move to what we call quick ratio, where they're just looking at your cash or items that will be converted to cash very quickly, right? So you're going to look at that current asset or cash value, and you're going to divide it by your current liabilities. What do you have to pay today? All right. And so hopefully for every dollar of cash you have, right, you at least can cover a dollar worth of liabilities. You want to at least come out break even, right? But in the creditor world, they want you to have $2 for every dollar of liability, right? That would be a strong business, $2 or more for every $1 of liability. I know, right? So this also answers a very important question that I'm going to bring up right now because I know you're serious business owners taking this class. You want to make sure that your business to an investor, right, is growing. And the only way you measure a growing business is by seeing assets grow. The whole point of owning a business is taking assets, cash, inventory, investing it into your business process so you can generate more cash, right? Yeah, that's right. You want to make money at the end of the day. And so if you are showing on a balance sheet where you're going to find current assets and current liabilities, if showing on that balance sheet that you have more debt than you have assets, slow down. Okay, that may be giving off the wrong picture to an investor, right? And you don't necessarily want to show that. You have to be very thoughtful about that because that will come across as using other people's money to grow your business and then increasing the risk for those investors to get their money out. So be careful of the story you're saying. And remember, this is going to tie into, um, whether you believe it or not, the collateral piece of the conversation. Because if you don't have assets, right, and you have more debt, there's no collateral value there to leverage. All right, so just remember that. All right, final factor that we're going to do is we're going to take a look a little harder at the collateral conversation. We're going to measure the collateral conversation, and that's a ratio they call loan to value. Very easy to figure out, like this is a no-brainer. You're going to take a look at the value of your assets. For instance, we had talked about the book value. You'd be just picking up the fixed asset value off the balance sheet, and you'd be comparing it against any outstanding debt, right? The liabilities on that balance sheet that are related or tied against that asset. All right, so let's say I purchased a car. I'd be looking at the car value, right? And then I'd be comparing it to the outstanding balance on my car note, right? And then hopefully I have more value than I do debt, right? And that would be a positive loan to value. So when you're going in and you're looking at that 3-point checklist, you want to hopefully have some positive collateral value that they can leverage against so that you have something to act as a secondary source of repayment. See, I'm teaching you my language here, right? So remember, this type of understanding of collateral value will go a long ways to see whether or not you have what you need to get approved. All right, so when you're running your numbers and you're doing your 3-point check, right, just remember you have the ability to run your numbers before they do. Right? It's always bad when you're giving them the upper hand. Run your own numbers. Know where you have weaknesses. Clarify for them where they might need to look in order to fully answer some of these questions. All right. I put these ratios in my loan proposals, in my packages. That way I have a conversation for them. One, if I can show that I meet those standards that we talked about, I meet the standards. That should help them get to a yes fast, right? If it's, I do meet the standards, but you have to look a little closer, I'm able to tie that into the conversation up front. And I'll give you an example. I'm working with a business owner right now who moved to the United States 2 years ago. He was a Canadian business owner with a franchise and sold those franchises to have a US franchise. So came over, same franchise, right? Same franchise. Came over to the US, took over a location. He's been here 2 years, so not the full 3 years. right? And he wants to grow. He wants to hire people. He wants to buy a building. And that's can be a hard conversation. Um, but what you don't understand is he's got a bunch of money in Canada. He sold some businesses there and he didn't bring all of it with him. And so when he was going around talking to lenders, he forgot that he has assets that aren't being disclosed, Canadian assets. He didn't think about showing that. And there's sources of income over there that are coming in from investment properties that is a big part of the overall conversation. When we updated the conversation and put in the additional documented support, then he got approved for the loan, right? But he had to understand his numbers and what the investors needed to see, and then it helped him realize he wasn't giving the best information for the communication that needed to happen. So remember, good conversations can come from being transparent and being informed. All right, team, so here we go. Lack of collateral. I told you I would get here. Here we are, lack of collateral. And I'm going to tell you, if I were to talk to business owners on their number one pain point, it would be this. And that's sad, right? Because we went through things like cash flow and we went through things that were also pretty important. But lack of collateral seems to catch everybody. So what if you're in the situation where you don't have enough collateral? What's next? What can you do? Right. Well, I want you guys to understand that collateral is not just cars and buildings and inventory. All right. Those are all convenient, like stereotypical types of collateral, but there's new forms of collateral out there that we deal with every day and people don't ever think about it. For instance, um, accounts receivable, right? So let's say I'm doing business and a client or customer is going to pay me, right? I've done the job. Now I'm waiting for the payment. I've sent the invoice, they'll pay me, right? That becomes collateral. That future money becomes collateral, right? Now let's say I need to purchase inventory before I can create the future money, right? That accounts receivable. So I need to purchase the inventory today. You can use the future inventory you're purchasing as collateral, right? Now just stop right there, all right? Because I'm just going to point this out. So I don't typically need anything right now. I can create opportunities and I can create my own collateral around those opportunities, and that can be used by investors to get money. Yes. All right. When people realize that all they have to do is execute well on an idea and they can create the opportunities for themselves, that takes people from being a small business to being a mid-sized business, right? Mid-cap, right? You can create the collateral if you structure the conversation correctly. Okay, so let's move on. Inventory, right? That is collateral. Merchant processing accounts, so credit card sales. So if you are, selling things online, right, and you're waiting for sales to hit, that can become a form of that future cash flow can become collateral for them. All right, personal assets. Can't be your homestead here in Texas. They don't allow that, right? But you can purchase money against investment real estates, raw land, believe it or not. All those personal assets, like your paid off car that your daughter drives, all those personal assets can be used as collateral as well. A new one that I'm playing around with, and that is called intellectual property, right? So IPs, that's collateral too. Has to look a certain way, has to be secured with insurance, right? But that could potentially be collateral for a conversation. Any equipment, right? Equipment of all types falls into collateral. And then something, and this is where it's so broad that I just want to give you a tipping point. Something that can be insured and that lender investor can monitor. All right. So think about that. We know we're building assets in our business. If we can insure the asset and we can monitor the asset growth, that becomes a conversation we can take to an investor. Wow, right? So maybe you do have collateral. Maybe you can create collateral within the transactions. Don't be limited, right? I would love for that to be like an open conversation. But most importantly, I'm going to point out that SBA loans do not have to be 100% collateralized, right? And this is, some people will vehemently argue with me on this, but I'm telling you, I've read the SOP. That's the standard operating procedure for SBA. It does not say they have to be collateralized 100%. What it does say is that it needs to be collateralized to the best degree of whatever collateral is available, ideally for $1 of debt to $1 of collateral, right? But the lender would have to agree with whatever that final outcome is, and SBA can do some loans unsecured. Just lenders like to protect themselves against undue risk. Okay, so if you don't have strong collateral, a lender could potentially take that to SBA and find some comfort in the SBA guarantee to offset the risk. Woo, we are learning today. So it is 3:09. I'm just going to go ahead and go over the summary. Remember, the summary is not the end. The summary is the pause button. We'll take the questions that have come into the chat. We'll answer those. But we're going to continue this conversation because I get to dive into more details coming up soon, right? And we're going to talk about lender likes and dislikes. We're going to get into the market. We're going to talk about how to start preparing. And hopefully by then you'll feel really good about knowing you've got a quality loan proposal. All right, so strong loan proposals, that's the conversation, answers the 5 C's of the credit question. And we went over those in today's conversation. It contains specific documentation needed to go into specific detail. Remember, that final person that's making that decision, it's not the nice person on the front end, right? It's that guy in the back end that nobody can talk to or touch, right? That is really into these details, introvert. You got to satisfy and communicate to that person in the package. All right, take into consideration what the lender needs to measure and document. You've got your 3-point check, right? And you want to make sure you're documenting those 3 points. It's catered to the person seeing, reviewing, and making the credit decision. Ironically, your strong proposal has to go through all those levels of individuals, those players, right? For you to be able to get the approval. So you need to make sure that your communication is to all levels. And more importantly, it's completely doable to come up with a strong loan proposal. It's completely doable and it's in your control. You just have to give it the time and the preparation that it needs in order to get there. Okay, so that's where we're going to hit the pause button. Remember, I am Rebecca Schultz. I love doing these presentations. It is so much fun, but I want to answer your questions now. So tell me, what questions came up?
Thank you. Roger's question you've already answered. And I must say, I have to echo what Roger said about the role of the SBDC advisor. Well said. I have a question. Now, does the SBA guarantee all loans, even a relatively small one like Marvin's? Or do they prefer larger loans? If they're going to go through the hassle, do they want to make sure that their money, the money that they're working with is big enough for their time?
Yeah, good question. So SBA doesn't care. That's the ironic part. SBA is out there for the small business owner, supporting access to capital, more importantly, getting out there and training and making capital available on all different levels. They are super happy doing small loans, or micro loans is what they call them, under 50,000 is the micro loan. They wish more lenders were out there giving those SBA micro loans out to businesses. The unfortunate side is that processing for those is very expensive, and SBA fees included, because there's packaging fees, don't make that a reality for a lot of the community lenders who are on a budget. You know, they run a business and they may not get a lot of money off of a very small loan for an investment. It just costs more to them than it does to produce it. So it would be the lender that would shy away from the smaller loans for a cost-saving measure as opposed to SBA. SBA is out there trying to get more community development financial institutions, involved to help with the microloans.
Mhm. Oh, okay. Great. That's actually very good to hear. Another question I have, and anybody else, throw your question in there. Oh, Roger's got his hand up. Go ahead, Roger.
Uh, I was just gonna talk about the how the lender is in control of if they're going to go down the route of an SBA loan or if they're just going to put it internally, correct?
Correct.
So all those same players are involved in just a regular conventional one minus the SBA, if that's
Correct.
concerned. And isn't it true that each lender itself, even though we have all these same players behind the scenes, each lender themselves kind of has an appetite for certain types of lending. If it was fast food, if it was, real estate only, if it was different things. Does that come into play on a lot of different things that you've seen?
Oh, yeah, very much so. The type of collateral that they're comfortable with and they find easily, able to liquidate or move, right? Their experience with collateral, all of those come into play. It's just like a business that likes certain customers, right? Or targets certain customers. Those lenders have that same type of targeted client that they want to support or that they can support based off of concentration and such. So that's where I would say work with your SBDC advisors because they are always in those conversations with those lenders and they're going to be a good indicator of who to start talking to and who not to talk to. They'll know if that particular lender does not work with restaurants, right? Or that particular lender, no way is going to do an airplane loan. Like, that's not going to happen. So you'll want to start using them to kind of guide the conversation.
And and lastly, and this may be part of your series, Rebecca, so if it is, we'll just ignore the question, but um, it, all of those factors that we just talked about, the collateral, the credit, all that stuff, kind of also then pertains to the terms that they'll come back with, right? The length
Right?
of time or the interest rate.
Yep.
So I
You
didn't
got
know
it.
if that was going to be, if that was part of something you were
Yeah.
heading towards.
Yep. You got it. So in part 3, we do talk about lender likes and dislikes. So we'll talk a little bit about what is doable, what's not doable, questions that you need to ask in order to make sure that you're really, pitching that proposal to the right party and then you're kind of framing it just right. I'm a big proponent of doing like a pre-interview meeting with your lender, getting a good feel for their personality and how they would, you know, approach a certain conversation. And you can really spend very little time on the front end making sure that it's worth your time to create the package and to send it to somebody on the back end. But yes, that's going to be part of part 3. So Joel, any questions?
I think you're muted.
Yeah, I left the mouse on the other screen. Yeah, I sometimes find myself understanding certain subjects, but when it comes to, like putting it down and writing it, it really helps to have examples. And I was gonna ask, like, what would be good examples of, good business loan applications and, all that put together that I could follow.
Do you want to see some? Like right now? I can show you one. You want to
Yeah,
see? Okay. All right, hang on. So, when I talk about levels of detail, hang on, I'm just going to bring
yeah,
up
because
something.
that's one of the things. Yeah.
the story, the package will change based on what you're
Mm-hmm.
trying to communicate, right? So the
Mm-hmm.
information, the communication is going to be key, but it's the information that goes to communicate the story. And in this particular story, hang on, I have to come somewhat protect names. So do
Yeah.
not mind. Before I share, I'm gonna just kind of make sure that you don't see the name. Yeah. All right, so welcome to my friend who had the asset that's in Canada, right? So this is a
Cool.
complete package.
Okay.
Does that scare
Wow.
you? Yes, yes. Okay, so notice we have tax returns, right? Not 2018 because he didn't have the business in 2018, but he was here in 2018. So I can get 18, 19, and 20 personal taxes, but only
Cool.
19 and 20 business, right?
Mm-hmm.
Here's interim financials, right? Actually, I got some newer ones. In this case, they're not US citizens, which by the way is not a problem, but they're here legally. So we just had to document that. So within the
Okay.
file is going to be their the residency documentation, right? I had to, because part of the story is he has the experience. I have to
Mm-hmm.
document that he has the experience, and so I put all of the transactions and even the wire details of how much money he was paid, backing up the sell of the other businesses to show that he was a serious contender, right? So that goes into this conversation. Recent bank statements. So interim financials often aren't enough. A lot of these banks in the current pandemic, they want to make sure you're not making things up. And so in addition to the interims, you have to go out there and get the bank statements that show that, and they can do a quick review and see that yes, those deposits match something similar to your gross revenue, and you're good. Lease agreements, right? So in this conversation, he's buying a building. I need to show that he actually has been paying lease and what he's been paying because I have to add that back into my cash flow, right? So I had to go out there and get the lease agreements. He is a franchise, so I had to show that there was a franchise agreement involved. So he was doing business legally under that franchise, and he can continue doing it legally under that franchise. A whole entire folder on cash flow projections with those written assumptions. All right. Because they don't know you from Adam half the time, you have to go and not only do the business history, you have to go and show them what you do. So in this case, we had samples of completed projects so they could see pictures of the completed projects to get a good feel for their work. This required construction detail, and I will click on this just because I think it's important. So you will do like letters of intent. You will be able to show specific details to what you're going to spend, right? And that level of detail is required. And I even went down because, in his case, he does have awards, right? So I had him take pictures of his awards so that they could understand that he has successfully operated or navigated this space for many, many years, and he's very good at it. So you can see business history, application submission, um, formation documents, credit reports, ran the numbers for them, proof of capital injection. You see what I mean? There you go. That is a package. I know, Joel. It's not a lot of fun to the outside person, but I tell you, when you go into those conversations and you can speak the language to those players that we talked about, I mean, it's a whole nother conversation. They're like, yes, we'll give you the money. How low can we give you the money for? How much you need more money? We got it for you, right? You overcome the hurdles to operating the business.
Got it.
How much of the required documentation is actually already part of the business plan?
Very little, unfortunately. That's one of my pet peeves. The business plan, although ideally it covers the 5 C's of credit, you need to support everything with the actual documentation that
Okay,
that
gotcha.
matches it. And so I feel like they many people get lost in that business plan conversation. They're
Mhm.
like, this is my target market and this is my competitor. And they get so busy trying to prove that the idea that they have is solid that they don't realize that's not what's 100% under scrutiny here. What's under scrutiny more than just the idea is going to be whether or not you've done it, that's your cash flow, and then whether or not you can pull it off, that's your character.
Mhm.
And so credit
Mhm.
reports and like I said, the awards and the records and I mean none of that would have been in that client's business plan. So
Gotcha. Gotcha. Um, just want to make sure that all of those documents that you showed us uh, for the business owner that is looking to create a loan package, they're not alone. The SBDC works to put all of that stuff together. It works with the business owner to put it all together and know the lender that's being approached and what they like and all of that. So it's going to be you're not alone in the process. I'll just say it that way. Um, any other questions? We good? Okay. Rebecca, as usual, it was fabulous. We appreciate all of your wisdom and can't wait to hear what you have for us in part 3. I'm sure it's going to be great. Um, I just want to share something with everyone. These are our upcoming webinars. And tomorrow we have one about doing a presentation, doing actual presentations, and with Lorna Kibbe. She is great. Then we have how to maximize your content marketing with Ashley Cook. And on the 28th, Rebecca will be back for part 3 of creating a bankable loan proposal. Like I said, I'm really anxious to hear what you have to say in part 3 to wrap it all up. It's really a great series. And then on the 29th, designing your presentation. There's more to come in the coming months. So all you have to do is go to our website and you can use that QR code that's in the upper right-hand corner. It'll take you right to our website. And there you can register for webinars. You can get contact information. You can schedule an appointment with an advisor. We have all kinds of resources for small businesses. And now we have something called Size Up. It's a database that you can actually go in yourself and gather all kinds of research information about competitors, about all sorts of demographics, just a really powerful tool that's out there for your use now. You're going to be receiving a survey. And if you would please complete the survey, and there's a part that asks for your email address. And if you would include your email address, we'll make sure that you get a copy of the presentation. Valuable resource. Anything Rebecca puts together is always so, it's worthy of sharing. Also want to thank our benefactors, the people that make all of this possible, the Small Business Administration, the state of Texas, North Texas SBDC Regional Office in Dallas, and North Central Texas College for the funding that we receive from them. And because we do receive that, we are able to bring to you all these resources and the webinars and consultations, everything to you at no cost. Thank you again for joining us all today. We appreciate it, and we look forward to seeing everyone tomorrow at What Makes a Presentation Effective. Thank you. Have a great afternoon.
You too.